Happy Friday, everyone. Jason Jacobi here with Boyer Financial, and this is your closing bell for the week. Little different scenery this week, right? Out in Palm Desert, California here, and I can say it is hotter than inflation out here. But enough with these financial jokes here, I promise, just for the meantime. But we're out here with the family as of yesterday, just for the weekend, little rest and relaxation, but wanted to get you the most pertinent information for the week. And I think that the main thing I want to touch on, besides what's below, there's a lot of economic data that came out this week, right? So main thing I want to touch on is inflation. So we had the personal consumption expenditure report come out this week, actually today, this morning, and the numbers are trending in the right direction. However, we are getting a little sticky around 4.5% inflation. That seems to kind of be the floor, the glass floor at this point. So that's just going to prompt the Fed. Again, I think we've locked in another 25 basis points here at next week's Fed meeting. But what investors are not expecting is if this 4.5% or 4.4%, or if inflation seems to be a little bit stickier, which it has been recently, then it might prompt them to raise interest rates again in the June Fed meeting, whether it's 12.5 basis points to another 25 basis points. That's yet to be seen, but I think we need to come to the realization that that actually might happen. Now, again, we don't have a crystal ball. It depends on the economic data coming out between now and then. But if that is to happen, so we have a lot of people at this point investing in really short-term, short-duration treasuries, CDs, bills, T-bills, notes, whatever it may be. They're fixed income instruments that are paying 4.5%, 5%, even 5.5%, depending on the bank or institution that you're using. I actually had a meeting with two big bond managers this week, two of the biggest in the world, and it came to light that while everyone's focused on the short term, what we really need to be looking at is actually extending the duration of our fixed income holdings to capture the great interest rates that we've seen this past year or so, right? As the rates increased, it was more advantageous to hold short-term bonds because you can capture the upside and the interest rate increases that take effect. But when rates stop rising or even start getting cut, which could happen here after the June meeting or later in the year, we don't know what's going to happen, and the R word comes into effect. We're worried about the R word of not recession, reinvestment risk. So let's say you bought a 3-month, T-bill a couple of days ago. Within 3 months, at your maturity date, it's more than likely that rates could be lower at that point. So you're actually going to get less for your money at that point. So if we extend duration, if you have cash needs now, short-term investments are fine. If you're just looking to make a little bit money on cash, but if you're just looking for getting the best capital appreciation or coupon for your buck, best bang for your buck at this point for capital appreciation, it's best to extend duration. So look out a year or even beyond and start to capture even 4, 5, 6-year treasury notes or bonds. Some top investment managers that we use to capture those higher rates while they're in effect. Because again, if you're owning a 4, 5, 6-year, which the bond managers think is the sweet spot right now, because not only do you have the 4.5, 5% coupons that are being paid right now, but you could have the potential for capital appreciation. So if rates get cut, it makes your higher coupon bonds more attractive. That's kind of where we want to start shifting the money to, which we have at Boyer Financial. We've actually been extending duration at this point. But I just wanted to let that be known to you guys, something to think about if you want to talk to us about it. Again, short term's fine if you have cash needs. Again, we've got our clients set up for that if they need it. But it's something to think about as we enter this next phase of the economy, recession, rates potentially getting cut this year. Again, just with the crystal ball, we don't know, but stay tuned. We'll keep you updated. We are thankful for you, and have a wonderful weekend. I know I will. Hopefully I don't get too sunburned. We'll see you next week.